The Property Bulletin by London Property, the home of superprime.
Homebuyers are facing an increase in property costs, as multiple dwellings relief (MDR) has been abolished since the 1st of June. This means higher stamp duty taxes for those purchasing homes with annexes or multiple dwellings. House builders, industry bodies and investment firms have warned that the removal of MDR could limit the market for buying and investing in blocks of flats, potentially resulting in between 13,000 and 25,000 homes not being built. Critics warn that this change will impact the housing market and drive up prices for homes with additional accommodations. The abolishment of MDR is expected to raise £385 million per year for the Treasury by 2028-29, with some buyers who rush to complete transactions before the deadline to save on tax costs. The proposed 5-year residency rule in Mallorca is causing a stir among UK expats and potential tourists. With the aim of reducing speculative buying and ensuring a long-term commitment to the region, this regulation could significantly impact those looking to make Mallorca their home. The recent protests against tourist overcrowding and demands for affordable housing reflect the growing tension between the tourism industry and local residents. While these measures may lead to a decline in tourism revenue and pose challenges for local businesses, they could also create a more sustainable and balanced tourism approach in the long run. The future of Mallorca's travel landscape hangs in the balance as these changes are considered. Ahead of the Bank of England's rate decision on 20th of June and the general election on the 4th of July, Investec chief economist Philip Shaw believes recent economic data does not strongly support a cut in the bank rate. Although consumer price index inflation fell to 2.3% in April from 3.2%, this was not as significant a drop as the Bank of England expected. Services CPI inflation only slightly decreased to 5.9% from 6%, while private sector pay growth, excluding bonuses, remained steady at 5.9% in March. These figures indicate persistent inflationary pressures, which could deter the Bank of England from lowering rates soon. Updated inflation and wage data will be released before the next Monetary Policy Committee meeting. While these might be more favourable, they may not fully meet the committee's expectations. The Bank of England operates independently of the government, and political events like the general election do not influence its decisions. However, Bank of England officials refrain from public comments during election campaigns, complicating market guidance. Given these factors, it's likely the MPC will keep the bank rate at 5.25% in June, with potential rate cuts beginning at the August meeting. Investec forecasts that, as inflation pressures ease, interest rates will gradually decline. By the end of 2024, the bank rate is expected to fall to 4.75%, and by the end of 2025, it could drop to 3.75%. The Bank of England's base rate influences various financial market interest rates, notably the swap rate, which affects fixed-term mortgage rates. As the base rate changes, so do mortgage and savings rates, reflecting market expectations of future policy rates. New research shows that while the wider London property market has struggled since Crossrail officially opened, locations with the Crossrail station have largely been protected from the decline in house prices. Property consultancy Benham & Reeves analysed house price growth across the postcodes home to each of the 41 Crossrail stations, comparing this to the wider market and the local authorities in which each Crossrail station is found. The research shows that across the Crossrail line, house prices in postcodes home to a Crossrail station have increased by an average of 3.3% since it first opened. However, since May 2022, property values have fallen by an average of 3.5% across the wider local authorities in which these Crossrail stations are found. This means Crossrail postcodes have performed 6.8 percentage points better, on average, compared to wider Crossrail local authorities. Since May 2022, the average house price across London as a whole has fallen by 3.5%, and this drop has been even greater at 5.4% across the wider London boroughs specifically home to a Crossrail station. However, London postcodes home to a Crossrail station have seen an average increase of 2.5% during the same period, a swing of 7.9% versus the performance of wider Crossrail boroughs. The same trend is evident outside of the M25, where Crossrail postcodes have enjoyed a growth of 5.7% since the line opened, while the wider local authorities have seen a marginal increase of just 0.3%, a swing of 5.4%. The W1 postcode, home to both the Tottenham Court Road and the Bond Street Crossrail stations, has seen the highest rate of house price growth since the line opened, up by 17.2% since May 2022. In contrast, the wider boroughs of Camden, minus 19.7%, and Westminster, minus 14.3%, which cover the W1 postcode, have seen the most significant reductions in average house prices of all Crossrail local authorities over the last 2 years. The Canary Wharf Crossrail postcode of E14 has seen average house prices climb by 11.8%, compared to a 9.1% reduction across the wider borough of Tower Hamlets. The RG10 postcode of Twyford has also seen double-digit house price growth of 10.5% since the launch of Crossrail, nearly double the growth seen across the wider area of Wokingham, 6.4%. In fact, 34 of the 41 Crossrail stations have seen positive house price growth across their respective postcodes since it launched, while 34 of the 41 stations have also seen postcode house price performance outperform that of the wider local authority. Prime central London property prices are now expected to drop by 1% this year, a shift from the previously predicted rise of 1%. This forecast revision by estate agent Knight Frank is due to declining demand. Tom Bill, head of UK residential research, explained, "Political uncertainty has intensified since Rishi Sunak announced a general election last week. The proposed changes to non-dom rules have caused hesitation in prime markets." Previously, non-domiciled individuals could live in the UK without being taxed on their worldwide income. Chancellor Jeremy Hunt's new plans limit this to 4 years, although he has hinted at possible relaxations. Labour's tougher counter-proposals remain undefined. Due to the deteriorating outlook, Knight Frank revised its forecast for prime central London, expecting a 1% price fall this year, down from a 1% rise predicted in January. However, they anticipated a cumulative growth of 16.4% by 2028 as a long overdue period of price inflation begins. Investec Wealth and Management reported that last year the average price of London properties worth over £1 million fell by 2.5%, or nearly £50,000. In the prime London lettings market, supply and demand normalised faster than expected. Knight Frank predicts a 2% average rental value growth in prime central London this year, down from 5.5% forecasted in January. Oliver Knight, head of residential development research at Knight Frank, noted that rental supply is unlikely to increase significantly soon. Private landlords face higher interest rates and tax changes, causing some to leave the sector, while build-to-rent supply grows too slowly to replace the lost buy-to-let homes.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the super prime property market.